Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Let's talk about Germany. Now, Germany released their inflation report, which came in way hotter than expected. The year-over-year, month-over-month number came in way higher than expected, which caused basically stocks and bonds, European stocks and bonds, to sell off and panic sell. Now, Germany is very important. It's the powerhouse that drives Europe. And if Germany, which is known to be the spine, the nation that brings stability in Europe, is still having problems with inflation, and you're seeing elevated, or you're seeing signs of sticky inflation, it's unable to come down, and it's still elevated, and the number printed higher than expected, and it's just having a tough time to go down because of food prices are higher, and energy prices, and etc., etc. Even though we've seen it come off from its peak, it is still a very disturbing sign that Europe, or maybe the ECB, which is the European Central Bank, may have to do more when it comes to rate hikes. Just like we're seeing in the US with the Fed. The Fed inching slowly, the US Fed inching slowly, raising rates, pushing that terminal rate to 5.5%. ECB, same thing, being more aggressive, saying that we got to do 50 basis point rate hike, and we probably have to continue on with rate hikes afterwards because the inflation is not coming down. And inflation is not coming down, which is causing yields. Look at the German yields. The 10-year yield skyrocketing. The 30-year yield moving up higher as well. The 2-year yield also looks like a chart of Bitcoin just straight up, because the ECB is continuing to come out with the hawkish rhetoric saying we got to do more, even though they were a little bit late, right? They were late to the party. You're seeing definitely, the Fed slowing down, maybe less hawkish than the ECB. The ECB ramping up their hawkishness, saying that we're going to raise rates, we're going to do it aggressively because we got to bring inflation down. And you're seeing the same problem everywhere else. Now, when you look at German yields, German bond yields, Germany yield curve, when you look at the 30-year to the 5-year, they're known to be a yield curve that doesn't really get into deep inversions. And with this hawkishness, with this higher inflation, with the ECB pushing out the narrative that we got to do more, you're seeing the yield curve invert into very deep territory, especially the 30 to 5-year yield curve. Deeper than 2008, first time in history. We did see the yield curve, the 30 to 5, in 2008 slightly turn negative, but first time in history since last year in 2022, it went into deep inversion, deep negative territory, and just in December and January, it made a new low. And that's because the short end yields on German short-term bonds, you're seeing those yields really skyrocket, move up higher. And if those yields continue to go up higher, the yield curve will continue to deepen, which signals that there's problems in the economy. And if inflation is not going to be solved so easily, and the rate hikes that the ECB is not doing anything, then how do we get to the inflation target of 2%? How do we get inflation to come down if the current tightening is not doing much? Now, of course, there's a lag effect. It takes time, etc., especially when you look at the US side. Now, the ECB, Europe's a little bit late. The US was more aggressive last year, and they're kind of pushing back and releasing their foot a little bit on the gas pedal. But here we have the European Central Bank kind of pressing on the gas pedal, or I shouldn't say gas pedal, the brakes. The pressing on the brakes harder here to try to bring inflation lower, right? So This is very, very telling when you look at the yield curve, especially Germany's yield curve, that you're seeing this inverted yield curve. You're seeing yields go up higher, the 10-year, the 2-year, the 30-year. Not only you've got a problem with inflation, but Europeans and people living in Germany are facing not only issues with higher prices, but the yields moving up higher, which makes rates higher, which makes your loans higher, which makes your mortgage rates higher, which is just adding up to more pain, which makes me wonder if there was one country out there or one nation out there that might fall first, it could be Europe as a whole, it could be Germany, and it could start to cause a trickle effect into other nations like the US and so on. Now again, I can be completely wrong, but definitely the yield curve is not something that you should ignore. It is continuing to be inverted. Same with the US yield curve. You're seeing it. The yields move up higher and creating a lot of pain for consumers and still unable to bring inflation down, which makes me think one thing. We may have to see yields continue to move up, rates continue to move up until something breaks and until that yield curve uninverts, starts to steepen. Then finally you can talk about easing or, more fresh money coming in or rate cuts and etc. But until then, if inflation is still high up and you look at the Germans' inflation report, still sticky, still hot, I don't think this is going to end very well, and I don't think we're going to get that cuts or a soft landing or no landing with whatever people are talking about online. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.